Hey, this is John Burpee and John Burpee and Associates. If you want to learn how to build an empire with your small axe, you should be listening to Small Axe Podcast with my good friend Nico.
Hey guys, this is your boy Nico, your host of the Small Axe Podcast. Hey, this show is dedicated to helping you become the best multifamily real estate investor that you can be. Now, whether you want to be an active or a passive investor, this show will give you all the resources you need to help sharpen your axe and build your own personal empire. So you know what? Sit back and relax and enjoy this show. And hey, if you find value in it, I would love for you to subscribe, leave a 5-star rating, and write a review. I love you guys. Okay, Small Axe community, we are back. And today I got a good friend of mine, John Burpee. Now, he was on this podcast once before, and I had to bring him back. And actually, I should be checking in with him every quarter or so just to see what is going on down in the Florida market, because he is an expert broker. Actually, you can say he is not just a lifelong broker, but he is a generational broker. So, and more, he's a property manager and more. So I'm going to let him come on and kind of explain a little bit about what he does, what he's up to, and what he has been up to for the past year, because we haven't spoken online or on air in about a year or so. So John, welcome, man.
Hey, Nico, how are you?
Man, I'm doing so good because I'm talking to you. And I would, we've been speaking recently, and I just, after listening to everything that you say and all the advice and insight that you have down in the Florida market, I felt like I needed to get you back on. So maybe if you wouldn't mind taking a minute or so explaining who you are, what your background is, and then we'll catch people up to what you've been working on.
Yeah. Happy to be on the show again. I've been a lifelong broker here in this market. My family were developers for 40 years prior to me coming to this earth, so to speak. My grandfather was a major developer here in the market, and I grew up in the industry. Been a broker pretty much all my life. We specialize, the way to think about our firm is we're a cap rate firm, is that, we specialize in multifamily, mobile home parks, but anything that's got a cap rate to it. We've been doing a lot of industrial deals lately. I've been doing a lot of the small bay industrial and the mid to upper level, mini box to big box type stuff. But really anything that's got a cap rate, to it. I used to own one of the franchises here in this area. That'll remain nameless, but we're a boutique firm. We've got 9 brokers working with us now, and we're all specialists. We don't do any overlap. We have a mobile home park team, an apartment team, a hotel team, and then myself. I do a little bit of everything, whatever my clients require of me on a daily basis.
That's awesome, John. Thank you for sharing. And where are you based, and where have you lived throughout Florida?
Yeah, I was born and raised right here in Tampa Bay area, in the St. Petersburg area. Our firm is right outside of Seminole in the Largo market. And we've been in this area, like I said, for 40 plus years in business. That's
great, John. Thank you. And, you mentioned that you do basically everything, and I've seen you do everything. And I speak with some of your brokers as well. I know Danny's got I think he's got a mobile home park right now down in Tampa.
Right.
How are you feeling about overall? I haven't seen you guys put out a multifamily listing recently. How are you feeling overall about multifamily?
It's overpriced. It's the easiest way to say it. I had this discussion last night. I was at dinner with an investor, and been a client of mine for years. And we talked about the divide. And, I used to say that there was always a stream that divided buyers and sellers. Well, that stream today has turned into a canyon. And, the bid ask gap is just the widest that I have ever seen it in my entire career. And it's all based upon interest rates, and it's based upon time, I guess is the easiest way to say it. I've been through 4 of these corrections in my career, and I can tell you that it usually takes 1.5 to 2 years for sellers to realize that they're not going to get the money that they were going to get last year or year before, when interest rates are artificially low. And, you're back into this stabilized rate environment. And, a lot of people are saying, oh my gosh, rates are so high, they're so high. But historically, if you look over the last 40 or 50 years worth of interest rates, we've always been a 5 to 7% interest rate market. And, so we're going back to a normal market rather than a reduced rate market and free money type atmosphere.
You know, it makes so much sense because once those interest rates got down to 3, even sub 3%, people were able to spend more and pay more for a particular property. And now that's not the case anymore. But just like you're saying, sellers are sticking to it and they want that price. And unfortunately, there's still some people that are willing to pay that, which kind of maintains that premise that they can still get that price. Now, also on top of the interest rate hikes, we've also been seeing crazy insurance interest, rising.
True.
And that's another thing that's adding to expenses. Is there any insight you have on that or not?
So I mean, it's all such a high level, politics in Tallahassee. And unfortunately, Florida has become the whipping child of the United States with this test on how much insurance companies can really push down the throats of consumers. And, a lot of it's political. A lot of it is that, that Florida has kind of turned into a red state. And now we're seeing the attributes of that. But at the same time, we're looking at long-term effects that this is having on real estate. And when we're talking to our clients on our property management side of the equation, we're telling them to basically figure that your insurance is going to double across the board. We're managing right now about 2,500 apartment units, about 1 million square feet of office, retail, industrial, and other type assets. And I have seen some of the properties in the coastal control line areas quadruple in price and on insurance. And then there's some properties you just cannot get coverage for. If you're on a barrier island and you're looking for wind insurance today, it's impossible. The only place you can get it is through Citizens, which is the state insurance company that's run by the state of Florida.
Wow. And what happens in a scenario like that where you can't get insurance? So you have to buy it all cash. You can't get a lien on the property. Is that right?
Well, they're talking about now is that a lot of the banks are able to do what's called forced coverage, where they have a master policy in place. So some of the political the hearsay that I'm hearing behind the scenes a little bit is that a lot of the banks are going to start offering insurance like they did back in the 70s and the 80s, to where it was a one-stop shop. You get your financing, you get your insurance, and everything right there at the bank. And they have what's called this portfolio or this master coverage type insurance for everything that's in their loan pool. So, some of that is going on now where borrowers are just saying, look, I can't get insurance and, can you help me? And they're having to force place this coverage. Unfortunately, that forced place coverage comes at a cost, and it's ridiculous in price.
Right. Well, all right. So looking at it at a different way, is there any government relief down the road? Do you foresee that happening?
I don't know. That's above my pay grade. So.
Well, that would be ideal, but at this point, we can't underwrite for it, right? So I'm underwriting for, even if I'm not in a flood zone, I'm underwriting for, $1,500 a unit a year, anywhere from 12 to 1,500 a year, depending on the location, even if it's not in a flood zone. Now, if you're in a flood zone, forget about it. I mean, you're over 2,000 a year for a door for most properties that I've seen, and it's just unsustainable. And I've even heard of people's residential insurance rates go doubling or even tripling down in Florida, which is just scary, and it makes it unsustainable. So, I don't know what's going to happen down the road. And yes, we were able to push rents the past couple of years, but that's slowed down significantly. So I don't know where the makeup is going to be. Perhaps it just comes back to what you were saying originally, where it's price, where we have to reduce the purchase price. Hopefully we get sellers to buy on that and agree to that.
Yeah. Well, the big problem is the inconsistency in the coverage. In that, what I've seen is a good friend of mine I was at lunch with last week was complaining that he's lived in his house for 22 years. It's a concrete block, 3-bedroom, 2-bath, 2-car garage, standard Florida ranch style home, worth in a neighborhood of about $400,000. And his insurance is $7,000 a year. He talked to his neighbor, and his insurance is $2,200 a year for the exact same house. Now, there's really no continuity across the entire spectrum of between the companies that are offering, insurance in Florida. The newer construction homes get a discount because they've got wind load windows. They've got, the newer rated, construction standards and everything. But, some of the older homes that were built in the 70s and the 80s, or 60s, 70s, and 80s, it's not uncommon for them to see their insurance rates $5,000 to $7,000, for a $500,000 home.
Wow. That's wild. We saw something like that here in New York, because I live in New York. I live on the beach. We had Hurricane Sandy hit.
Right.
half the town got demolished, and in my house in particular, we had to knock it down and rebuild it. And if you did not rebuild and you did not lift and raise a certain amount of feet, then your insurance went way up. And I remember I was paying $400 a year at that time, and then I was staring down at $2,200 or $2,500 payment a year increase, right? And thank God I got my house lifted, and now I still pay
Yeah.
$400 a year, which is
Yeah.
phenomenal. I'm in a flood zone as well.
Well, that's the same thing that's happening in the Fort Myers market right now, is that with the hurricane that went through there, it totally destroyed Fort Myers Beach. There isn't anything down there that wasn't touched in some way by the hurricane. And we've got a deal right now working on a site that was previously a very large hotel. And we're talking with the city, and the city is telling us that exact same thing, is that they're in the process of redoing their new comprehensive plan. They're looking for at least 2 stories of parking underneath any dwelling structure going forward.
Wow.
So what you're going to have is basically this stilt structure, 8 to 10 story structure that's going to be a flood pathway on the first 2 floors.
Yeah. Yeah. North Carolina, South Carolina, I believe they went through
Right.
it as well. And yeah, so everything's on stilts on the beach there now. We have these floodgates and flood vents in my house where, if we, God forbid, we were to get flooded, we would be fine. But it's just wild. But I mean, to make that happen on many of these residential homes, I mean, you had to just lift the house or build from scratch, which is not
Right.
really doable for most people.
Right.
All right, John. So let's talk a little bit about, this is a good segue into how you find leads. So like, I'm sure you talk to people all the time. You've been doing this forever. So do people come with you? Let's just stick on the multifamily topic for now. Do people come with you and say, hey, John, what do you think this is worth these days? Or do you approach people and say, I think I can get you this. And would you want to sell? I know a buyer that's looking for something exactly like what you have. How does that process work?
Yeah, it's a little combination of both. Being that personally I've been in the business so long, I've got a book of business and a book of clients that will call me from day to day and say, John, I'm thinking of selling this, or John, I want to buy this. Do a search for me, find something for me along that lines. We still do a tremendous amount of direct mail. We still do social media marketing. We still do cold calling. It's a combination of everything across the board. And then, of course, the management company as well, it has a symbiotic relationship with the brokerage side of the business. So, you may get something on your management side that says, hey, I'm ready to sell, find me a buyer. And that comes right into the brokerage side. And then the same thing with that, when we sell a new property to a new client, hey, we happen to have a management company, it comes right into the management company.
Great. And what is your range for that management company while we're on that topic? Like, where do you cover?
We'll cover the entire state of Florida if it's a large enough asset. It has to be at least 100 units or more for us to cover it out of the Tampa Bay area. But the majority of the portfolio right now is in the Tampa Bay area. We've managed from Miami to Tallahassee to Jacksonville if they're a large enough asset. If you can get an on-site manager and an on-site maintenance person, on-site staff, the management aspect of it is a lot easier. As you well know, in the industry, that the bigger the better when it comes to apartment complexes.
Okay, great. Now back to the question of leads. When let's say a seller approaches you, hey, John, I want to sell this. Do you give him an opinion of what it would be worth and then say, I think I might have a buyer for you, or what is that process like?
Yeah, so it's funny you asked that, because literally last week, that's exactly what happened. As a client called me and said, John, I've got this 8-unit property. I sold it to him 20 years ago. And he says, I think it's time for me to move on. I own it free and clear. I think the money's used somewhere else better. So, he says, this is what I think it's worth. I said, that's great. Send me your financials. I said, before I even go look at anything in today's market, I want to see your rent roll and I want to see your P&L statement, and I underwrite it. And 9 times out of 10, when I underwrite it, they get sticker shock. You can't sell something today at a 5 cap and expect to pay a 7% interest rate at the bank. The inverted yield curve is also an inverted cap rate curve right now. And, you're looking at assets that people still think, and going back to what we just talked about, still think are going to sell at a 5 cap. And when you show them on paper, this is the bank underwriting. This is directly from the lender. This is how they underwrite the deal, and this is what they're going to do. And they say, well, why does interest rates affect my property? Well, this is why. When you want a 5 cap, I can't sell that to somebody with a 20% down payment. That guy's got to come to the market, or that person's got to come to to the deal with 40, 50% down sometimes in order to make it work.
Yep.
And that eliminates your buyer pool going forward. I mean, there's only a certain amount of people out there that are willing to put 50% into a deal and just let it sit there.
Yes, absolutely. Awesome. Now, when you're valuing, things went to like 3.5 caps, at one point. I remember, I'm talking A class down there, low fours.
Yep.
When you're looking at properties, do you typically assign a localized like market cap rate or per class or do you do it like just in general, everything should be a 5 or 6 cap?
No. You've got to do it by class. You've got to look at it also whether or not it's a, class A brand new construction in downtown core type of a market. That's a totally different buyer. That's an institutional type buyer that, is totally different than the 8, 10, 12 unit, urban core infill, or urban infill type of an asset. That's the small mom and pop investor. And, they're looking to put money in it. Maybe they're going to live in one unit and they're going to rent the other ones out. We're seeing a tremendous amount of that request right now is that people from the north selling their big house that they've lived in for 25 years and they've raised their family and they're going to come to Florida and they want to live the Florida lifestyle, and we want to buy a small apartment complex near the beach and they want to live in one unit and rent the rest of them out. And so when you go through the dynamics of it and go through the math and explain to them what it's going to take, people get their eyes opened.
Yeah, it's competitive regardless of what you think. I'm just going to get a 5 unit or something or a 4 unit, fourplex, but it is competitive at that,
It is.
door count as well.
Yep.
Now, back to the cap rate question. So let's say this guy says, hey, I want to sell for my 8 unit. This was your conversation last week. And you hit him with a price. Are you factoring in a potential purchase price for him? Are you factoring in any pro forma of what he's like? Maybe he hasn't raised rents in a few years. Are you factoring any of that in with your valuation?
Not on actual value, unless it's just so far out of the market that you can go in and raise rents $300-400 per unit. Then yes, but if you're $100 off, it's not worth factoring it. It's going to make a little bit of value, in the deal, but at the same time, the buyer has now switched the mindset to say that, well, if he could do it, why hasn't he done it? And I'm not going to pay him for my work. So pro formas to me are kind of like toilet paper. They're only good for one reason, and that's it. And today, banks won't underwrite on pro formas.
Mm-hmm.
They have to have actuals. Appraisers have to have actuals, and they're going to use the actual current today's rent roll against the T12 expenses. And we talked about this before, and I think in the last podcast was that you see these pro formas come out that have 30 and 35% expense ratios, and it's just not feasible. When we take a new property in, someone calls on our management company, says, hey, I want to bring this in, I'm buying this property. The first thing I ask is to see their OM. And when I tell them I can't manage it for what you're buying this for on expenses, and I don't want to be the bad guy, a year from now, when your expenses are 45 and 50%, you're buying it on a 30% ratio.
Yes.
So when you explain that and when you walk both the buyer and the seller through, where the market is, what the debt coverage service ratios are today, and, what they were a year ago, they get the bigger picture. They understand it. They see it.
John, this is one of the main reasons why I can't wait to do a deal with you, because you obviously come from the perspective of also being a buyer, and you know what it's like to be on the buyer's side. So you're very realistic, which is why I appreciate, all of your insight and advice and guidance. And I've taken your advice and guidance on it numerous times. So thank you. And we're going to nail one together, man. Here's another question. When was the last time you bought something personally?
Well, I sold everything last year. About 16 months ago now, we sold everything and we're just sitting on cash waiting. So 3-4 years ago, it's about the last time we bought something. We might have left a little bit of money on the table. I probably should have held on to the portfolio probably about another 6 to 8 months. But at the same time, our gains were so tremendous. And, when you're making 300% on your money in 18 months and 2 years worth of time on a turn, it's hard to turn that money down,
Yeah, absolutely, man. I think you got out at the perfect time because things started getting crazy. All right. Now, last time we spoke, you were talking about receivership. What is that?
Yeah. So court-ordered receivership is when a property goes into foreclosure and there's an income stream or there's a reason for the lender to feel that the debtor may not keep the property up and may not, be able to keep the property from deteriorating. So the court will come in and assign me as the court appointed receiver. And basically I walk into the property and take the property over. If there is rents coming in, if there is deferred maintenance on the property, if there is something that needs to be done to keep the property from deteriorating in value, I step into the shoes of the owner. Essentially, the debtor at that point cannot even come back on the property without notifying me that they're going to be on the property for some reason or other. A case in point, I've got a case right now on a small property that I was appointed on that has an environmental issue. And the bank wanted to get the environmental issue cleaned up prior to taking it into their portfolio so that they don't have that trail of environmental issues. So they appoint me, I come in, the bank funds the cleanup. I contract with the environmental contractor and with the crews to do the testing and cleanup and everything else. And then we get a clean bill of health on the property, and then the bank takes it onto their balance sheet in a foreclosure. Another scenario is that I literally have a apartment complex that has been in foreclosure for 9 years, that I have been in receivership on for 7 years, and is now going in front of the Supreme Court with relations to a contract issue that was between the banks and the debtor from the initial start of the loan. So some of these things can drag on for years and years and years and years and years. We were appointed the receiver on the largest asset of foreclosure of a fractured condo deal here in the Tampa Bay area. It was 1,000 units. When we got there, literally the next day, there was a $300,000 insurance payment due, and there was that much money in the bank. So you get into these fun situations like this, but it's to protect the quality of the property. It's to protect the asset from deteriorating, and it's to protect the cash flow so that the debtor doesn't try to steal everything else, because he feels at that point he's already lost or they've already lost. So they're just going to try and take as much cash flow as possible. I've walked into scenarios before on 300-400 unit apartment complexes or 300,000 square foot shopping centers, and the debtor has absconded with all the security deposits and just walked away with $300,000-$400,000. And unfortunately, the tenant are the ones that get hurt.
Wow. That is heavy, John. Now, you also mentioned that at one point in time, you had a lot of these receivership cases. That was during the Great Recession, I believe. And are you seeing any similar trends now? Not that I don't want to predict that this is some indicator of doom and gloom, but are you seeing certain trends now?
Yes. So in the last 5 years, I would have an average of, let's say, 1 or 2 a month coming in. In the last 6 months, it's gone to 3 or 4 a month. And it's a lot of oddball properties. Churches right now are just a tremendous amount of churches. I've done more churches in the last 2 years than I've done in my entire career.
Wow.
And it's always a tough thing. I mean, you don't want to be the guy that evicts God from the church, but at the same time, it's still an asset. It still has debt on it. You still have to figure out, what to do with it. Oddball properties like the little, 8 and 10 unit hotels in the middle of the state of Florida, Avon Park or Sebring or something along that lines, where there's really not a tourist industry type base, and they were surviving off of that local traffic. And, maybe that local traffic dried up for one reason or another. Something happened and the demographics change in that market. So, those come in every now and then. The bigger issue is the calls I'm getting from my old clients. The calls I'm getting saying, John, are you still in business? Because we're seeing stuff coming down the pike. John, we just want to make sure you're still doing receivership work and we can count you as a vendor. We're going to see some foreclosures here pretty soon. So when you start getting calls like that from major lenders, I mean, the BOAs and the Wells Fargos and everybody else out there in the world, that there's something behind the scenes happening.
Yeah. Wow, man. Really, really interesting stuff. And on this note, I want to ask you another question. This will probably be one of my last questions, but this is based on the fact that a lot of my friends that are limited partners in deals in syndications across the country have seen operators pull back on distributions, have seen operators, come run into issues with occupancy and delinquency. And on our property down in Lakeland, we haven't seen that yet. But my question now is to you regarding how is occupancy and delinquency? Has it been affected at all yet down in Florida?
We haven't seen much of a drop, but we have seen a slowdown in new tenants coming into the area. Now, I don't know if a lot of that had to do with such a harsh winter up north and, things haven't thawed out, so to speak. But, we have definitely seen a pushback on raising of rates, of rents. It used to be we could get $100 bump every time we turned a unit. Today, we're struggling to get $25. The amount of traffic has slowed. The pickiness of the tenant has really come to the forefront in that, when we had a tenant walk through a unit just the other day with a checklist, and I don't know where they got this checklist from. This is the first time it's ever happened to us. They literally turned on every faucet, looked underneath the sink, checked the water pressure, checked, what's the age of the appliance, what's the age of the air conditioner, checked every window to make sure every window went up and down. And they got this checklist somewhere off the internet. And, our regional manager said to us, this is the first time I've ever had anybody do this. They signed the lease and they moved in. There wasn't anything that, they could find, but that's how picky tenants have become. And they want to know what they're getting for their money.
Interesting. That makes sense. I like it.
Yeah.
Well, it is proof that people are still moving down to Florida, at least. We can't necessarily push rents as we have been, but the occupancy has not really been a serious issue as it has been in other areas of the country yet, at least. And let's hope it stays that way.
Well, I think it goes to Florida. And what we were talking about before is that, I posted something on our Facebook page today is that Florida's population is now over 22 million. We crested the 22 million mark last month, and they're expecting that to grow to 24 to 25 million within the next year to year and a half.
Wow.
So we're still seeing a tremendous amount of influx. We're still a year behind on the amount of housing and the amount of construction that we really need in the state of Florida. I was talking with a group of residential realtors. I was giving a speech there last week about the state of the commercial market. And their feedback to me was exactly that. There's no inventory. And, even though the market has slowed and pricing has taken, let's say 25% of the buyer out of the market simply because of interest rates, the remaining buyers are still aggressive and still going after, and they're still seeing multiple offers on residential homes in good areas. And at the same time, for every house that's listed, there's 3 buyers, and it's still a little bit of a bidding war.
Mm-hmm. Have you seen any cutback or pullback in building new construction?
No.
Okay.
No. Maybe a little bit in anything outside of residential. But residential is just on fire. I mean, you just can't build enough of it, whether it be for rent or whether it be for sale.
Cool. John, you're the man. And I appreciate you. And I want to, just be mindful of your time. So we're going to move to our final question. And
Okay.
This is the doozy question. And you've answered it before. I don't remember how you answered, but I'm excited to hear what you answer with today. Let's imagine it was 100 years from now, John, and you have great grandchildren. They're super happy and they want to write a book about you just to honor you and your life and what you were able to provide for them. What would you want to title this book?
Well, I have great grandchildren now. So
well, they're going to be in their 90s by the time they write this, I guess.
Yeah,
You have great grandchildren now.
we do. Yes, we do.
Wow. Congrats,
Yeah,
man.
yeah,
That's
thank you,
so great,
thank you.
great grandchildren.
Maybe that he was just an honest guy. I just feel that, there's no sense in me putting something in front of you, whether it be real estate wise or anything else, that is just not the truth. And if I can't present you an honest deal and tell you that I can perform as a broker, as well as a manager or whatever it may be, and I'm going to put my own money into that, then I shouldn't be putting that in front of you.
I love it, man. You are certainly an honest guy, and I appreciate that.
Thank you.
All right, John, let's get to the listeners some form of contacting you.
Yeah, so you can reach us at either on our website at burpeecommercial.com or email me direct at john@burpeecommercial.com. And we have Facebook page. We have all the stuff there like everybody else does. So
awesome, John. So it's been wonderful today, catching up on air. I truly appreciate your insight and your opinions and just how you see the world down there. And I can't wait to do a deal with you. So thank you.
yeah, love to. As soon as I find something that works, I'll send it to you.
I know, man. I know you will. I trust you. Thank you so much, John. I appreciate you.
Absolutely. Thanks for having us on again, Nico.
Yep. Hey, Small Axe community. I would like to say thank you for listening to another episode of this podcast, where we show you how to use your small axe to build a lasting empire. Now, if you like what you heard, it would mean the world to me if you could leave me a 5-star rating and write a written review. Hey, let's take it one step further and share this podcast with someone that you feel could benefit from it. And until the next episode, keep sharpening those axes.